Welcome to the final session, the new SRI, Sustainable, Responsible, and Islamic Finance. What we're going to be talking about today is the areas of expanding Islamic finance to encompass new areas of consideration. So you have the Sharia principles and the Sharia compliance, which focuses on financial sustainability and systemic sustainability, reducing debt, reducing uncertainty, but then there's a movement to incorporate factors around environmental sustainability and social sustainability that is developed in parallel with Islamic finance and is increasingly being incorporated into Islamic finance, really to address the expectations of the next generations of people who are going to be directing the world's wealth and the Muslim world's wealth in particular. And promoting greater convergence in practices means you don't have to necessarily reinvent the wheel. And so we have some people who have taken unconventional paths around Islamic finance who have been ahead of the trend in incorporating environmental and social sustainability with Islamic finance. And so we're going to hear, I think, some very good stories from how they've gone through the actions they've taken, why they've done it, and how Islamic finance now is sort of taking up some of that experience and incorporating it across the Islamic finance industry. So we'll just turn it over one by one to hear the stories of the panelists, starting with Amir Rahman from the UN Development Program.
Great, thank you so much, Blake. When we speak about Islamic finance, we typically have this $2.5 trillion narrative. We talk about the industry size being $2.5 trillion. We talk about banking. We speak of capital markets. We speak of asset management. And this $2.5 trillion narrative is an important one. And it's one that I'm very much proud of being part of over the last 20 years of helping build this industry. But although this narrative is important, it is incomplete when we speak of Islamic finance. And so the $2.5 trillion narrative is meaningful and it's important, but it is incomplete. And there are at least three types of issues associated with this narrative. One is the idea of scale. So while it's an impressive number, it's very small, of course, compared to global flows of finance. Second, and perhaps more important, is the point of differentiation. And as we've developed the Islamic finance industry, we've certainly achieved scale in many markets, and we've penetrated the banking system, which is very important. But many look at Islamic finance and see that it conforms with religious law, but it may not be having the social impact that many aspire for in the area. Third, and also very important, is that it's not as inclusive as we'd like it to be from a number of dimensions. And one of them is that we must recognize that a very small minority of Muslims engage in the commercial Islamic finance sector, be that having an Islamic bank account or investing in an Islamic fund or subscribing to a sukuk. Now, the chart you have here has two sets of data. The bars on the bottom represent the market share of Islamic banking assets in a particular country. So you'll see Malaysia is at about a quarter of the banking market is Islamic. Bangladesh, 20%. And moving on with the list, you can see the various countries: Jordan, Pakistan, Egypt, Indonesia, and Nigeria. And you see that the market share in these countries, which are large population Muslim countries, is modest but meaningful for Islamic finance on the commercial side. The orange line is a response to a survey conducted by the Pew Research Center on the percentage of people that engage in zakah. And you can see it's many-fold bigger. So in Indonesia, for instance, you have about 5 or 6% market share for Islamic finance, but you have 96% of people saying they engage in zakah. Remarkable. In Malaysia, with 25% market share for Islamic banking, amongst the Muslims, more than 90% of Muslims say they engage in zakah. So when we include zakah and social finance in our understanding of Islamic finance, not only is it much larger, but perhaps more importantly, it's inclusive of a broader range of people, all of whom apply their ethics to their financial practice, whether that be on the commercial side or on the social side. The social finance elements, of course, are very strongly linked to the Sustainable Development Goals. And these 17 goals would be familiar to many of you who are attentive to development finance. And one of the projects we're undertaking and looking at UNDP is when we look at Islamic social finance and Islamic finance broadly, how does it serve each of these goals? And I'm very pleased to say that when we look at the legacy of Islamic finance and taking, for example, the Waqf sector, the endowment sector, you'll find endowments for each of these or many of these goals. So you'll find endowments, many endowments that address hunger by feeding people. You'll find countless endowments that address education by educating people. You'll find endowments pertaining to healthcare, and so on and so forth. So we find that in the Islamic finance tradition, there's a great deal of SDG alignment already in place. And so that is something that Islamic finance can look at as something in its heritage that is very important, has made contributions to the world, and as we move forward in financing the SDGs, Islamic finance certainly has something to offer. So at UNDP, we're working with Islamic finance stakeholders in 3 different ways. The first is what you would call harnessing, and that's when Islamic finance stakeholders are giving grants to UNDP, and we are implementing projects on their behalf. And we've been doing this for well over a decade with the Islamic Development Bank. We also have started doing this with zakah collectors, most notably in Indonesia. Basnas, which is the national zakah collecting agency in Indonesia, is giving grants to UNDP. We are implementing projects on their behalf. The grants are collected by them. The Sharia criteria around zakah come from them. So we as UNDP do not take opinions or enter the area of religious law, but rather Basnas determines that, and they give us grants which are consistent with our charter, our principles, and we implement projects. And that, for us, is a very important partnership, and we look forward to building more of those. So that's what we call harnessing. Second is aligning. And in terms of scale, this can be even bigger than the harnessing. And here we work on existing flows of financing to align them better with the Sustainable Development Goals. So one example is our partnership with Al Baraka Banking Group out of Bahrain, which is active in 16 countries across the world. And what we're doing is working with them to align more than $600 million of their loan portfolio, of their financings, with specific SDGs. So they will, through their partnership with us, be able to say that this $600 million of financing served this particular SDG or that particular SDG, and here's the impact that it had. So this is their core business, to provide financings, and we are helping them align that with the Sustainable Development Goals. And I think this is a very promising opportunity because banking comprises the core of the commercial sector of Islamic finance, and the more banks can align with SDGs, the more scale we can have for this SDG alignment. We also have a platform called the Global Islamic Finance and Impact Investing Platform, GIFIP, which is working with asset managers on the impact investing side as well as Islamic finance to bring those communities together. And finally, we participate in convenings. For 4 years consecutively, we've hosted events at the UN General Assembly to raise awareness on Islamic finance and its potential for financing development. So these are the ways in which we at UNDP are engaged with Islamic finance, and we believe that there's a great affinity between sustainable development and the Islamic finance community. This opportunity can be very compelling if we do these 3 things. Number 1, I believe it's important that we expand our understanding of Islamic finance to include not only the commercial sector, but also the social finance side. The Islamic Development Bank estimates it can be as much as $1 trillion per year in zakah alone. We need to build or recognize the linkages that we have inherently between Islamic finance and sustainable development. As mentioned, the Waqf sector is one example. Zakah, of course, has a lot of impact for social development. And even in the private sector work we do, the Islamic finance sector is much more aware and attuned to its principles and values and social impact than many in the private sector, and that is the strength of Islamic finance. And finally, it's important to work on identifying and measuring SDG impact. It's a field that has experts in it. It's something that the Islamic finance community can benefit from and adopt and integrate, and in doing so will demonstrate its relevance to these global goals that are being serviced across the globe.
Thank you. That was very enlightening about Islamic social finance and Islamic finance and the impact measurement. We'll move on now to Abdul Hasib Bassett from Ellipsis.
To the last slide?
That's right.
There we go. So while the slides come up, I'll just introduce myself. I'm Abdul Hasib Bassett. I'm from the UK. I'm co-founder and principal of a firm called Ellipsis, which is a digital structured finance firm. And I'm also the chairman of Yielders, which is one of the first Islamic fintechs to emerge out of the UK. It's still the only FCA-regulated fintech, Islamic fintech in the UK. And I'm going to take a slightly different tilt to what I talk about. It's more of a personal journey of how I came to be involved with the new SRI. So my background is really in 3 stages. The first in conventional finance, where I worked for a decade in traditional conventional banks, tier 1 banks in the West, focused predominantly on technology and strategy. So in the earlier waves of technology adoption within banking and the strategy around that. And this period of my career I define as being profit-led. So everything I did was predominantly for the profitability of the bank. And we all know how that ended in 2007 and 8 and continues to behave like that. Moving away from that conventional finance sector, I did investigate the Islamic banking world and trying to find a place for myself in that sector. And to my disappointment, I found that a lot of what I saw, especially happening in the UK, was still very profit-led. And so utilizing my skill set at the time, I moved into fintech, which was just taking off in the UK, and I had the privilege of setting up an organization called Innovate Finance, which was the brainchild of the previous government and their policy unit. And the aim was to build an inclusive ecosystem and community for fintech as it was emerging in the UK. And so predominantly the work we did here was around ecosystem development and enablement of tech-led businesses. And that's not only fintech businesses, but that's actually banks and how they can utilize technology as well. And through this work, I actually found myself back in Islamic finance, in that Islamic finance was a slightly late adopter to fintech, and in coming to conferences like GIES, speaking about fintech and engaging with companies that were looking at their own technology and how they could utilize fintech. This period of my career I call being advocacy-led, because really the work here was around supporting the community from within and supporting the community without, especially with regulators, governments, policymakers, and really showing them how they can create more of an enabling infrastructure for technology. What's interesting and why I chose the 2 pictures to represent those is that there's something missing in those 2 pictures, and that is really the human is there, but they're kind of obscured. They're not really thought about. And so in the current phase of my career, which we're calling the new SRI, really where I'm focused now is looking at the infrastructural gaps, both in ecosystems and in financial markets. And this era is solution-led for me. So this is really looking at the impact and the human impact of what these companies are doing. And so we all hope that the companies that we work in and develop have the impact on the human as much as, or make this as happy as this lady is with her mobile wallet. So just a few learnings from sort of the work in ecosystems. So one of the first things when it came to Islamic fintech was it became a thing a few years ago, and nobody really knew how many companies were out there, which ones were Sharia compliant, which ones marketed themselves as being Sharia compliant, which ones were inherently Sharia compliant. There wasn't even a definition around it. So part of the work that we did was really to landscape the Islamic fintech firms around the world. And in the first iteration, we found 110 firms, many of which were in the UK. The UK was actually the second highest producer of Islamic fintechs after Malaysia, which was a bit of a surprise to us. And the second outcome of that was helping to set up something called the UK Islamic Fintech Panel, which Harris, who's the chair, was on the previous panel on this stage, and really trying to address some of the common problems that those firms have. And they have many of the same problems that a lot of early stage tech businesses have, but they tend to be exacerbated by the fact that they that they're seen as Sharia compliant. They're almost seen as niche and not mass market, which is completely untrue, because they are set up from scratch to be mass market and solution led. What we're trying to tackle right now is really what I call Me Too ecosystem strategies. So that is looking at places like Silicon Valley and looking at places like London, which have natural advantages, and trying to adopt those same strategies for other parts of the world where you want tech-led businesses to emerge. And so some of the work I do now is with governments and regulators on how they can build unique strategies around their own capabilities, rather than trying to replicate what's happening around the world, which might not be fit for purpose where they are. So most of the companies I work with now really are addressing the gap, and I think Amir touched brilliantly on this. Really, 2 trillion in assets, which is less than 1% of global banking assets, a population that's almost 25% of the global population, and and on the previous panel as well, it was discussed that if you look at the 1.7 billion people unbanked in the world, which are the World Bank stats, about 70% of those are in Muslim countries. So if Islamic finance is doing the job it should be doing, we wouldn't have this stark gap. And so really what I'm encouraged by is that a lot of fintech entrepreneurs that I work with, really what they're trying to do addresses an element of this gap in some way. It might not be directly focused on the retail consumer, the unbanked, but there is something about inclusivity, sustainability, and ethics that permeates everything they do. And that's what gives me hope that Islamic finance really has a role to play in the future of finance. So I think the way forward is that it is that solution-led outlook. For me personally, it's working with pioneers in the space that are looking to address that gap, and alongside that, build the enabling infrastructure that's lacking to help them scale, and really make sure that we stay true to the human aspect of what I've been talking about. And again, this picture I took of Canary Wharf, which, if anyone who doesn't know it, is one of the financial centres in London, and it's poignant to me because that whole journey that I've talked about, from conventional finance to advocacy to being SRI-led, has happened in those cluster of buildings. So it is possible from within to enable change. And the final message I'll leave you with, I think Islamic finance needs to be solution-led to become an enabler for human, social, and economic development. And for anyone that wants to reach out, those are my details. Feel free to get in touch. Thank you.
Thank you. So I think from this point we've seen a fairly limited engagement from traditional Islamic financial institutions working around ESG and Sustainable Development Goals. And I think there are institutions that are active in this area, and so we're going to hear about the journey that's happened at Sedco Capital from Ayman Al-Bashir, the head of International Business Development and head of Client Advisory at Sedco Capital. And so I'll turn the floor over to you.
Thank you, Blake. I'm honored to be here. Allow me to share with you my company's journey in this regard. So Sedco Capital is a global asset management firm that offers attractive investment opportunities across global markets. Since our inception in 1976, Sedco Capital has adopted a Sharia-compliant approach only, and was able to craft 3 decades of stellar performance in most asset classes, including public equity, private equity, and real estate. Our story has begun following the 2007 and 8 financial crisis, when was approach to investments and finance was revolutionized, if I may say. I think theories and explanations started surfacing about doubtful investment structures, vehicles, greed, short-term unsustainable models, which eventually caused the crisis. Like in any crisis, many investors would learn from previous mistakes and try to be more and more prudent in their investment approach. As such, a couple of aspects came to note for us, and at Sedco Capital, after the crash and during the crash, we looked at, number one, the Sharia investment universe as more resilient and less volatile than the rest when it comes to comparing it to the wider universe during and after the crisis. And number two, that ESG, or ethical investing that focuses on ESG, environment friendly, socially responsible, and governance driven, was on a rise. And in our spirit of, our continuous spirit of enhancement and innovation, we explored further these two topics to find out that both ethical and Sharia investing embrace sustainable economic development. And our commitment to sustainable economic development for the future for generations and our ethical and Sharia approach of investing drove us to develop our new prudent ethical investing approach to have stronger performance, better sustainable businesses and economies around the world. This approach combines between ESG and Sharia. Setco Capital has been embracing since its inception or since the beginning of the business the goals and objectives of responsible investing and Sharia investing. And in 2014, we were the first Sharia compliant and asset management firm in Saudi to become signatory of the United Nations responsible UNPRI principles of responsible investment, and we are proud of it. And since inception and since then, this responsible investment approach has become a core part of our investment process. Financial and non-financial criteria define the long-term risk-return profile. And when we look at prudent ethical investing, for us, it's not only avoiding unethical sectors, it's more than this, it's also taking into consideration the quality of balance sheet and avoiding excessive leverage and highly levered companies. So for us, PAI is an evolution of responsible investment. PAI stresses on transparency and due diligence. PAI is a style of investment that would bias portfolios toward higher quality and better growth prospects. It is a way of avoiding excessively leveraged companies, as I said, and therefore improving the risk-adjusted return for portfolios. And it also demands and seeks better understanding of the underlying investments, cash flows, structures. Lastly, in terms of performance, I know it's an important question that people would like to ask about it. We've done an analysis on the public equity asset class, which is the asset class where everyone can access to its data. Over the past 10 years, since 2007 to 2017, we looked into different indices and we compared the Sharia compliant, what we call prudent ethical investing performance versus unrestricted versus responsible only. And it was quite evident that prudent ethical investing, the Sharia compliant indices, not only reduced the risk but also improved the risk-adjusted return of portfolios during and after the crisis. And it is quite evident that such kind of investing, prudent ethical investment would expose portfolios or would bias portfolios to factor exposures like growth and quality, as I said. This is only the beginning. We're sure that there's more success to come, inshallah. And yeah, that's pretty much it. Thank you very much.
Yeah, so I think the example from Setco shows that what we've talked about in terms of environmental and social impact can work, and impact can work within the context of a commercially focused financial institution. And there's also, on the other side, there's a role for social business in promoting where the commercially focused businesses can. And so, Shiza, if you want to go ahead and explain your background.
Sure. Well, wait for the slides. Oops. Okay. Hi, everyone. So my name is Shiza Shah, and I'm going to talk a little bit about my journey, but also where we're at currently with UpEffects. So if we look at since the start of the Industrial Revolution, we've seen humankind make monumental strides in the fields of technology, science, and business. And, you know, humankind has now progressed to a point where we've realized that we've made these achievements at a cost. You know, in the pursuit of filling our libraries with books of knowledge, we've cut down our forests. In the pursuit of a quick turnaround on clothing inventory, we've invested in a system of cheap labor and sweatshops. And in the pursuit of faster and faster modes of transportation, we've literally burnt our natural resources and are now smothering our planet. So what we're realizing is that no system in the world can progress too far without morality, which is why many in the world are now paying the price. Accumulated wealth sits in a small number of pockets around the world, and with that means that the gap between the rich and the poor has widened. And while the rich reap the benefits of excess wealth, half of the world is still living in extreme poverty. And so we've seen that, $400 billion were donated to charities in 2017. And how can this be? Why are we in this situation? And this is a question that confused me for most of my journey. And I spent a number of years working for nonprofits. I was volunteering and wearing assorted hats in different functions, raised thousands of pounds. And during that time, I failed to see my work yield any meaningful change. And what I realized that my questions on fund allocation were often squashed or ignored. And these issues were prevalent across the sector. People donate to charities with the best of intentions, and they hope that their contributions will aid the poor. But much of this capital can be lost in unsustainable programs, administration, or tick box reporting, ultimately failing several communities and trapping many in an endless cycle of poverty. Based on that, I realized we needed to explore other models. And that's not to say that charity is bad. It's one of the core principles of being a Muslim. We're encouraged to give back to those less fortunate. But what I would like us to question is how charity is allocated. And so I started to look at social enterprises as a model and realized that tackling social and environmental problems was really no small undertaking. And if we were going to succeed at that, we had to leverage the same infrastructure that successful businesses were built on, which is profitability. So as I delved further into the social enterprise space, I saw an immediate synergy between Islamic economics and social entrepreneurship. Concepts such as fair trade, ethics, justice, and community enrichment were being celebrated as new models, but really they existed at the time of Prophet Muhammad, peace be upon him. Beyond that, what I saw that conventional businesses were finding success with investors, and those same investors were bypassing social enterprises because they were really only interested in funding entities that would increase their wealth. And a lot of those entities were founded by founders of the same profile, whether they were white or male. So these opportunities weren't being afforded to social enterprise founders, often women or ethnic minorities. And so we were frustrated by this. And so my co-founder and I set up UpEffect, which is a crowdfunding and support platform for social impact businesses. And it's built on the premise that anyone that has the potential to have an impact on the world should really have that opportunity to turn their idea into a venture. And so as Muslim founders, we took inspiration from Prophet Muhammad, peace be upon him, whose examples in business dealings always espoused honesty and integrity. And what we really saw that poverty cannot thrive in a correctly implemented Islamic financial system because the system will not fail the poor. The poor will always be attended to, and there would always be a fair distribution of wealth in society. But despite all the wealth accumulated in Muslim and Western countries alike, and after trillions of dollars in philanthropy, we're suffering from one of the biggest moral crises of our time, which is global poverty, with 2 billion people living on less than $2.50 a day, which is absolutely preposterous. The fact that we're living in a world like that, and so I personally believe that we don't currently have a correctly executed Islamic financial system in any worldly nation. It exists in small fragments, and it's succeeding in small fragments around the world. But we need to bridge that gap. And although impact is increasingly on the Islamic economy's agenda, we're still playing catch up to the social enterprise world, which is very unfortunate given that investing in fair trade and ethical practices and positive products is one of the core tenets of the Islamic financial system. So, we decided to change this at Up Effects by equipping entrepreneurs with the skills and resources so that they could build impactful ventures without relying on debt or investment. And we're adopting kind of the Mudaraba framework in the sense that we bet on our founders by taking no upfront fees, and we help these entrepreneurs get market ready and find the right customers. So literally building a market around demand and supply. And if these entrepreneurs succeed with a crowdfunding campaign, we take a success fee, and if they fail, we then share in the losses. So the two problems that we're really tackling in the $2 billion crowdfunding industry are low success rates and harmful products. Most of the major crowdfunding platforms suffer from limited curation, lack of personalized support, and are mass market focused. Whereas in stark contrast with Up Effects, our enterprise solution and campaign consultant model has driven our 100% funding success rate. And comparatively, if you look at the other crowdfunding platforms, they rely on sensational stories and one-offs for their successes, which is why over 60% of crowdfunding campaigns fail. So what I saw that, the Islamic financial world has been quick to champion ideas that have the prospect of increasing wealth, adhering to the absolute minimum Sharia guidelines, but has been slower to provide a space for impactful ventures to thrive. And so Up Effect basically cultivates the space for these socially responsible businesses. And one example is Jan Pakistan. They were funded through Up Effects, and the capital allowed them to build the first commercially available cook stove for rural Pakistan, which allowed them to tackle energy poverty, provide income opportunities for the locals, and at the same time improve the health of those working within that community. Another example is Little Difference. They raised capital from over 400 customers for hand-designed recycled greeting cards, and for every card sold, they planted a tree with the help of locals in Madagascar. Again, this provided opportunities in terms of education on reforestation and the impact of deforestation on locals, as well as providing employment opportunities and helping lift these people literally out of poverty. And so we're really driven by the fact that the poorest in society should be able to trust that the system will not forget them. And I'm of the belief that entrepreneurs and consumers together can really build a world of financial equality and economic prosperity if they work together to address these problems. If we literally look at what 6th century Arabia looked like, back then justice, ethics, and community enrichment, they weren't a subgenre of industry. It was just the norm. It was how businesses used to operate. And all, social entrepreneurship is gaining momentum in the 21st century. I think that's a screensaver. But yeah, although social entrepreneurship is gaining momentum in the 21st century, what we're realizing is that we really shouldn't need labels like Islamic finance, social enterprise, or ethical finance for that matter, because every business should operate with those elements at its absolute core. And so I think even if if anyone doesn't subscribe to the Islamic faith or not, that doesn't really make a difference, because if we are using businesses to serve humanity, we really can tackle today's greatest social and environmental problems. And so I think together, if we work to build a self-sustaining economy, we really can do that if we're using business as a means for good. So, yeah, thank you, everyone.
Great, thank you. So we have a few questions for the panelists, and then we'll open it up for a few questions. Ayman, in terms of how the ESG gets incorporated into Islamic asset management, how does the fragmented nature of the Islamic asset management affect that, and how do we overcome that? How can larger asset managers like Sedco become involved to help speed up the transition?
It's a great question, Blake. Thank you for this question. We faced a lot of challenges in the past to approach global managers who manage different asset classes for us. And we've came across different answers from the top performers. One, sometimes it's relevant to the amount of money we want to manage. Sometimes it's relevant to why would I bother by accommodating your request if I have so many of investors that are running after me to invest their money in a conventional way. But I think in order to overcome this, we need to gather up, avoid fragmentation, and we launched our Luxembourg platform, and it was an initiative to reduce this kind of fragmentation. We have around $1.6 billion invested on that platform in so many different diversified liquid asset strategies. And we do welcome and encourage others who are interested in investing in an ESG compliant approach or a prudent ethical approach, as we see the ethical investors are candidates, good candidates to fit with our offering, to come and approach us and discuss with us if we can host their funds. And the challenge here is seed money. We do a lot of efforts, in order to attract AUMs, but we always want to see others who are interested in this area to always to come to us with some also AUMs, because we cannot just keep diluting the amounts of AUMs in a smaller range of funds, and just to diversify the offering for the global investors to invest in a Sharia compliant and prudent ethical way. We would like to see these kind of interested parties to come with also some AUMs in order to just maintain the size of each fund we have.
Yeah, it's about collaborating to expand
Economic
Islamic,
scale.
and make the industry sort of self-sustaining and growing, so that it can start to attract a lot more than it has in the past. So it's great to see it, and great to see sort of the engagement between different asset managers that you've been working with. How, Abdul, how can technology help with this in terms of integrating ESG and Sharia compliant investment? How does that help open up possibilities that would otherwise be very costly in the past?
Well, so technology in this instance, to me, is the enabler to get to the consumer that you're looking to target. I come from a Western market, as do you. There are many more ethically minded investors that are looking for opportunities. Yet there are very few IFAs, or in the UK, or advisors in the US that will provide sustainable, ethical investments as a service, mainly because they themselves don't have the full spectrum of what's available. What technology does is allows you to package those in a way that's accessible for the consumer, and in many ways cut out steps to get to the consumer, so cut out the middleman. So platforms like Shiza's are aggregating and taking the available investments that fit a certain profile and making it available to the public. We're starting to see that now permeate the robo-advisory space. We're now that sort of external innovation happening in fintech is now making the banks take notice that this is a viable asset class and an investment product that they themselves can offer. They just haven't had the technology capability in-house to be able to do that in many ways, or have not seen the profit potential in it. So, as I mentioned, being profit-led, you kind of sometimes miss these opportunities. But it takes someone who's solution-led and trying to address those issues to use technology as the enabler to do that. But then more people start taking notice, and that's a role I see technology playing. I don't think technology necessarily is the nirvana is going to solve the problems. You've got to start with the problem at hand that you're trying to address, and technology certainly gives you an opportunity to leapfrog and bring it to market quicker.
So we've seen the supply side and we've seen the demand side as sort of the intermediary side of engaging those who are looking for capital with those who have capital. How is social finance engaged in that, and how do platforms like crowdfunding portals contribute to bringing more capital into the social and responsible finance space?
So, I mean, the beauty of rewards-based crowdfunding is that it's recycling money that's already there in the economy rather than creating money out of thin air. And I think the perfect economy is where there is a trade of goods and services, and that's what rewards-based crowdfunding enables. Entrepreneurs that have a product or a service to sell, they're finding connecting them with those customers, and technology facilitates that by increasing the scope of the market that they're tapping into, which they weren't previously able to. I think there's definitely room for donation-based and equity-based crowdfunding platforms, but I think it's secondary. I think for to mitigate some of that risk that investors take in these businesses, they should first lean on rewards-based crowdfunding campaigns, because it allows entrepreneurs to prove demand for those products and services, prove that there is a marketplace for what they're trying to sell out there. And then if they need follow-on investment, they can either go to angel investors or rely on equity-based crowdfunding. The problem with Although, like I said, there is room for donation-based crowdfunding, but the problem is there's not much vetting happening in terms of the organizations that are being funded through those platforms. And I think so I've addressed some of the problems that exist within the charitable space. I think if there are platforms out there that are able to put the best social impact nonprofits out there in front of donors, then we'll see a much better result in terms of the impact that's happening in those communities. Because there's not much impact measurement, there's not much transparency, I think there's still scope for us to improve those areas using crowdfunding as a tool. But I think it's going to play a vital role within the Islamic economy. And I think a lot of businesses are now realizing it's actually a great means of raising capital rather than relying on debt or investors.
Yeah, and so I think we've seen a lot of evolution over the last few years so that we have these things like platforms of using technology to reach investors. We have fund managers bringing together Sharia compliance and ESG. What is the next step? We see the younger generation really focused on addressing environmental and social impact and measuring it. Where are we headed next?
I like your term generation, because it's important to remember that before the 1990s, the Islamic finance sector was not even investing in public markets. There was not yet the understanding of how we could engage with public markets, so it was just banking, and then there would be direct investments into companies that did not violate Islamic principles. So it's been, this generation has been able to see that they can invest in markets and they can invest in world-class structures and securities without compromising on their religious values. So I think that's a major step forward. For the current generation, as you said, the millennials and those who are now interested in more, they've already accepted that they can invest in markets without compromising on their faith, but now they want to see the positive aspects of their faith that Shiza was referring to. Where are the elements of sustainability? Where are the elements of positive change? And I think that's where the opportunity lies for greater differentiation, is to show those positive elements. And, I also think it's important to celebrate and recognize the origins of the ethical system that informs Islamic finance. And, I like to look at a waqf as the original mechanism for sustainable development goals. Literally. Sustainable, because a waqf has to be permanent. That's what, to be a waqf, it has to be a permanent asset. So it's sustainable. Development, because it has to serve a social purpose to be a waqf. And goal-oriented, because in a waqf, it's very clearly defined what the objectives are, and they have to be serviced in perpetuity. So SDG financing has been existing in Islamic finance for a very long time. It's great for us to recognize that, to be part of the global system, to communicate it broadly, and to really move it forward.
Great. Thank you. I think we have time for a few questions. So if we can just take maybe a couple questions, and if you want to address it to somebody in particular, please just mention that.
Thank you very much, Blake. Thank you, Blake. A general question for the whole of the panel. Yeah, you've spoken about UN SDGs. Yeah, does anyone on the panel know about any project that actually addresses one of the UN SDGs, at least from a systemic level? I mean, solving one of the UN SDGs, yeah, as opposed to trying to do piecemeal palliative care.
Hey, you want to start answer?
Well, on the point of systemic change, so of course the SDGs are designed to make, the reason why there's 17 of them is that it attempted to take a holistic view of development and saying that no single goal can be achieved without the others also moving forward. So that's why there's 17 of them. Now, I can say from a UNDP perspective, part of what we are able to do is we work with governments on governance and policy to, at least within their country, have a structural change. So the work that we've done, for instance, in Indonesia with Basnas, in service of their zakah administration, is helping service a number of SDGs. For example, number 1, no poverty. And not only through specific projects, but also helping Basnas itself improve its administration, improve its policies, improve its structures. So I think that is a step towards what you're talking about with systemic solution. But really, this framework of the SDGs is to show that you need all these parts to come together if the system is going to be successful.
All right. Does anyone else want to address that before we go to the next question?
I think a lot of the SDGs overlap as well. So a lot of the impact that companies are having on the ground, they're interlinked in terms of, for instance, energy poverty. It also has a ripple effect into the economic opportunities that aren't being created for those societies, but also health, also education. So I think it's hard to define just one single SDG being solved by an organization, as many of them are addressing a variety of those goals at the same time.
I think we have another question. We get the mic over.
Yes, I thank the speakers. And my question is about the Waqf. Do we see in the future for our speakers them to entering or stepping into a Waqf investments? Because if we speak about sustainability and also development, Waqf is a great model. The oldest Waqf is the Waqf that's been created by Uthman bin Affan and it still runs and benefits people. Mm-hmm. So social responsibility in the Muslim world does exist, but to which extent can leaders could help us as normal individuals create also our own Waqf? Thank you.
You mentioned the Waqf.
I did. We're very excited about Waqf. Waqf, indeed, as you said, serves. There are Awqaf for any of these sustainable goals that you look at. You'll find Awqaf that service them, and that's very exciting to see. You mentioned the well of Uthman bin Affan. So there you've got sanitation, you've got infrastructure, and then of course it also serves nutrition in the sense that you take the water out, feed animals, and that helps in terms of nutrition. So there are a lot of benefits in Waqf. We at UNDP, we work on development, which is to increase resilience in the long term. So Waqf is a great tool for increasing resilience, because even if you start with relatively small proceeds from the Waqf, it's a permanent source of funding for that goal. So we're very enthusiastic about this. We've published some thought pieces on this. And we believe that Waqf should, first of all, be recognized for the role it's playing in sustainable development. And second, more Awqaf going forward should map and make explicit the SDG impact they're having as part of their national development plans.
Do we have any more questions?
Hello, hi, how are you?
Yeah.
Thank you so much, panelists, for making this a frisk discourse. I had a point of question when it comes to the income inequality, and this is towards all the panelists. I have also I'm a student back in UK. I've come from Edinburgh, and there is a massive income inequality. What many people probably do not realize exists in the Western world. It is just not the Eastern world which suffers from it. Like, for instance, we all know the distance between the Eastern European and the Western European. The UK, which from the place where I've studied, it is ranked 4th in the OECD Organization of Economic Cooperation and Development. The first is USA, the second is Mexico, third is Israel, and fourth is UK. We have seen the role of conventional banks, the corporate banks, the investment banks, the role they have played. After the deregulation in 1980s, at the financial market being deregulated, the cryptocurrency coming in 2008 and being deregulated as well, securitization playing such a pivotal role during the 2008 financial recession, which was a massive fraud. My, cutting my long question short, how can Islamic Bank curb this problem? Because in the end of the day, I was very touched by your story. The weak and the poor always suffers. As we saw in the 2008 financial recession, which was hit heavily in Asia as well, many of the people got unemployed. Millions of dollars were lost. During the dot-com bubble, $3 trillion was lost. During the Black Monday, which was 1987 stock market crisis, which started all the way from Hong Kong to the west of Europe and as well as USA, $124 billion was lost. So can Islamic Bank, other than the conventional banks and the corporate banks, play an essential role to curb this sort of a tragedy?
We'll give you a break. I think absolutely, yes, they can. I think inclusion to me is many things. There's the stark sort of problem that we talked about, which is the sort of individual and being included in a financial system. Quite frankly, banks don't want to include them because they're not profitable. That's just a reality. So will Islamic banks solve that problem? I'm not entirely sure. I think they should if they're truly Islamic. But what I see is more entrepreneurs with fintech solutions looking to solve that problem. So actually trying to eradicate layers of value within the value chain that's being extracted in every part of finance by going direct to the consumer. Inclusion to me means more in terms of, in the UK, another problem that we have is that the small to medium enterprise sector is hugely underserved by banks. It's the largest job creator in the economy. It actually generates most of the tax revenue, but banks can't access finance. Banks don't lend finance to SMEs. And so that's a huge opportunity. And the government's actually made some really good strides in that over the last few years, encouraging alternative forms of finance, giving them allocations of capital from government and other sources to help tackle that. But we're only seeing the beginning of that. There's a lot more that needs to be done. And so part of the work that we're doing in the UK is really looking at the government organizations or the NGOs related to the government that are looking at funding alternative finance, educating them on how they can produce an Islamic product as well, where Islamic finance firms and fintechs can take advantage of it as well.
I think I'd also ask, sort of in the context you mentioned about banks, but also in capital markets, the research you've done has looked at sort of how Islamic finance performed relative to the whole market and SRI across multiple years, including the financial crisis. What did you see in terms of...
Just to add a couple of points, I don't think it's directly linked to the question, but from when where we sit as asset managers, we try always to avoid investing with managers that relies on cheap sweat labor or child labor, and this is, I think, indirectly is helping the area of maybe improving the income of people in need by trying to avoid them from getting disadvantaged by those who can try to just appeal them to work for cheaper money. We also, I think moving in that direction from asset management perspective will help eventually. But from performance perspective, I think the main driver for the outperformance in the prudent ethical investing is avoiding our clients into getting exposed to the highly levered companies, because these companies are very vulnerable during the crisis times. And we always explain to our clients, given that we are Sharia, and in Sharia you can only do long, you cannot short, that avoiding such companies will benefit you because they are more sustainable when it comes to their business models, because less vulnerable to facing headwinds when it comes to financial conditions. And that was proven by the research that we've done when we looked at the 10 years and even the longer term kind of performance. Just compare plain vanilla kind of comparison between Islamic indices and the conventional indices, we would see that difference because of the leverage impact.
Can I just add to that?
Yeah.
I think any capital that is ever distributed, whether it's by banks or it's by institutional investors, I think it should come with that educational piece. So where banks are distributing debts, it should be with the motive that they will be able to enable the borrower to return that in an efficient way and in a way that will help them become financially independent rather than them becoming reliant on the bank for further debts. And the same would apply to investors. I think it's important that investors are sharing their skill set, their networks, so they're enabling these businesses to become financially independent. And then beyond that, I don't think the solution necessarily lies with Islamic banking. I think it's a new wave of entrepreneurs that are going to address most of these problems that exist within the economy and help alleviate some of the stress that exists in terms of many people that are living in poverty right now.
Yeah, okay. Can you, if you're going to have a follow-up question, just short, because we have to wrap this up. But, yeah.
Yeah, I don't think regulation. I don't think regulation is the solution. I think we're too far down the road with conventional finance to regulate some of these practices out entirely. We're living in a interest-based lending economy. We can't regulate it ourselves out of that. We've got to actually develop an alternative, and develop a new system that essentially rivals that and shows that it can be done another way. I think that where regulation can help is really enable those types of companies to come to the fore, so actually level the playing field for other types of finance.
I think that's a good place to end the session. Thank you to the speakers. Thanks to the audience for staying to the end of GIES. And yeah, thank you all.